Welcome back, everyone. Every once in a while, I find something. I find something on the internet or something that I read that I think is just too good. It's too good to keep to myself. I feel compelled to share it with someone, just to bounce ideas off of and let other people know what I'm thinking. Luckily, this happens from time to time, and I have a big audience to share it with. So today I want to share something that I thought was just great, a just great find on the internet, and it's with a super investor. It's a super investor that I don't know much about, but I'm learning about rapidly. The fund, in fact, this really isn't one super investor. It's more like a team of people working at a firm. It's actually a big team of people working at a firm. But unlike most firms where it's kind of hazy and they don't really have any great investing strategy, this team's really good. They have really good returns. They have averaged around a 14% return for the past 15, 20 years. So it's a really strong return. And it's David Pullen. In fact, the fund is called Pullen Capital Management. Now, what drew me to this fund, the reason that I was looking at it, this super investor, was specifically because you may notice something when you look at the portfolio. You just may notice some commonalities. I was searching some of my holdings in to see what other super investors hold it, and I just noticed that there's a huge overlap in the amount of holdings I have in my portfolio with this fund. There's a lot of them. Their top holding right now is Amazon with 13%. So they own a ton of Amazon. It's more than I think any other super investor fund out there. And then their second largest holding is Microsoft, another one of my big holdings. So they got Amazon, they got Microsoft, and then they have ServiceNow. This is a high quality compounder. It's on my watch list. I view ServiceNow very similar to Salesforce. They're both kind of in that same category of large, growthy software companies that have immense pricing power, sticky network effects. Really good company is number 3. Then we have Google, and I think they just have GOOG. Maybe they have GOOGL, but at least they have Google right there as a 6.39% weighting. So it's like their third or fourth largest holding depending on the day. Google is another company that I'm bullish on, that I have a significant stake in. So out of the top 3 holdings, or top 4 rather, I own 3 of them. Then another company they currently own is Adobe. This is one that I don't own right now, but I have owned in the past. I really like Adobe. And again, I look at these holdings and I just love all of them. I love Amazon. I love Microsoft. I love ServiceNow, Google, and Adobe. I'm looking at this thinking, I see things similar to this fund or whatever they're doing. Then I look further down the list. We have Netflix is a huge holding compared to what most investors put it as. It's a 4.79% position. So they've dramatically overweighted Netflix. And when we look at the history, they were buying into Netflix heavily at the same time I was. This is right when Bill Ackman was selling out of it. These guys were buying in. So they must have had a similar thesis on Netflix that I had during that time period. So again, Netflix is their 6th largest holding. You go down the list and they got MasterCard is number 7. MasterCard is like my 2nd largest holding. You have Salesforce, another company that I've gone over many times. I really like Salesforce. Then you have Visa, the second duopoly with MasterCard. You have another company that I think is very interesting, Accenture. This has been a long-term compounder. It's beat the market for a long period of time. And then you have Abbott Laboratories. After that, it starts going below the 4% position weightings. You get into Airbnb, which is another one that I'm very interested in. I like Airbnb. And then United Healthcare. This is another quality compounder. Now you get down to 3%, and then I start to get some disagreements here. This is where I don't know these companies as well, or I don't have as big of theses on them. PayPal's one, I see why they'd buy into it. Cheap valuation. You have Autodesk, Thermo Fisher Scientific, and so on and so forth, going into the 2% weighting. But when I look at the top 15 holdings, top 10 to 15, I really like what they're doing. I like their portfolio a lot. I like the construction of it and all of these companies in it. And I think it's very interesting that they're one of the unique super investors that has such a massive weighting towards Amazon. So when I find a firm like this that piques my attention because they seem to see things similar to how I do, it always makes me want to figure out what they're doing or what their research process is, see what type of similarities I have with them. Now, I didn't know anything about this firm, anything about their history. but I just started to research online. They recently did a podcast. One of the members, the the most senior people at the firm did. I listened to that, and they had very similar thesis and way of looking at things that I did. They look for companies that they consider to be mid-teen growing compounders, companies that are very reliable and predictable, and they have what they call as guardrails. Now, they employ a bunch of analysts to put together all the individual research. So every single one of these companies in their firm has a separate analyst in their firm covering it. Like there's some analyst that's assigned to each one of these, and they cover them and they weight them based on how big their prediction is on these companies. But regardless, their criteria for looking at stocks is very similar to mine. Upon doing further research on it, I dove into their fund. I looked at their different commentaries and different things they're doing, and I found a portfolio update. So I thought it would be interesting just to go through their portfolio update, seeing as they have so many holdings that I do, and see their commentary from the fourth quarter of 2023. So this is their most recent commentary on their portfolio. And just to give them credit, again, a lot of these funds, like they might talk the talk, but walking the walk is different. You have to actually outperform. When you look at them against the S&P 500, they have beat the S&P 500 by a meaningful amount. From the beginning of this, over 10 years, they have returned 14.5%. Net of fees, that's 13.5%. So they charge a hefty fee that takes away from that. As individual investors like myself, there's no fee. So I don't have any type of net or gross. It's the exact same. Mine is just gross. But regardless, there's this 14.5% gross against the S&P 500 that is 10.75%. So they've beat it around 4% annually for over 10 years. Now, to be clear, this isn't crushing the S&P 500. They're not like doubling and tripling the performance of the S&P 500, but they're also not running a super concentrated portfolio. It's pretty diversified across a lot of companies. They have a lot of 3 and 4% positions. So given the fact that they're playing it a little bit conservative, they have a diversified portfolio, and they're beating the S&P 500 soundly for over a decade, I think shows very, very good returns. This is a very attractive situation for a fund. So I like what I see here with the returns. I like the portfolio construction. Let's go ahead and just dive into their commentary on specific companies in 2023. And they start off with Netflix, which of course is one of my core holdings. During Netflix's pandemic grow-over issues in 2022, the market seemed to believe there was little revenue for free cash flow growth left to be had for the business. Of course, that was true. The pandemic had pulled forward user growth, and the company then disclosed that there was over 100 million households that were using Netflix but not paying for it by borrowing paid users' accounts. That was, of course, true because it was so easy to share. Who wasn't sharing Netflix passwords? Everybody was on their parents. I mean, it was just like a common thing. Like everyone you knew had someone else's Netflix password. That was the case for every single person I know in existence, like anywhere, had someone else's Netflix password. After we assessed this information, better understood how the company could monetize shared passwords, and realized the win-win for Netflix and consumers from introducing an ad-supported subscription tier, we meaningfully added to our position in Netflix in the summer of 2022. We saw a clear path to a much better monetization of already a robust and differentiated platform with continued commitments to improving content spend, efficiency, and free cash flow growth. That is almost identical to my thesis going back to 2022. I looked at the password crackdown situation, I actually ran the math, and I did not see any scenario whatsoever where it hurt Netflix. They simply had so many people sharing passwords that even if those people were no longer customers, it just opened up the total addressable market for Netflix substantially. So right off the bat, I agree with their analysis. And of course, this has been a huge winning bet for them over the past year. You can see here, they added to Netflix dramatically during the price decrease. So if we look at this here, they added a lot in Q3 of 2022 when Netflix was around $230. Now Netflix is way above that. It's over doubled. So they were buying the stock at a low, adding 53% to their position. So very good trade by them. Very good analysis on this firm. Now they say fast forward to today, Netflix has made meaningful progress on monetizing shared passwords and laying the foundation for consumer choice. Although the ramp in advertising tier subscribers remains in the beginning stages, the low-hanging fruit may have already been picked up on the password sharing effort. But our research shows that there should be long tails of revenue and free cash flow growth. Right there, that's what I like to see. Just to repeat that last part. Our research shows that there should be long tails of revenue and free cash flow growth. In our opinion, Netflix remains the most advantaged and profitable streaming service with opportunities to continue adding subscribers and raising prices as it demonstrates more value to consumers over time. Over the long term, we also expect significant advertising revenue. So they see a very bright, prosperous future and growing free cash flows for Netflix, but they do mention that they've trimmed their position slightly. That said, the market finally seems to have anticipated some of this. As a result, we have trimmed our position from approximately 8% of the portfolio to approximately 5% in the quarter. So this grew to a huge position, 8% of their portfolio. You can see again that they don't like having too many positions that are above like 4 and 5%. So if one of them grows a lot, they're usually taking gains from that company, reapplying to something else that they see a little bit more growth in. Now, for me personally, I'm a bit different. I look at Netflix now. I don't see any big reason to sell the stock. Like I agree with them. It's going to continue growing cash flow. I could trim it now and take some gains, but I'm just not in a situation where I need to. I don't feel like that's necessary. And even after trimming it, they still hold it as a 4%, in fact, 5% position today. So they have a huge portion still in Netflix. Moving on, they talk about ServiceNow. Now, this is a stock that I haven't covered that frequently, but ServiceNow is one that I haven't dealt with personally myself, but I've read a lot about, and I know that it's an incredibly sticky company that has huge network effects. It continues to grow revenue and earnings at above a 20% rate. That's very fast, as they have for many years. The company has a software automation platform that efficiently builds applications on top of and across many enterprise functions. The Now platform can automate almost any workflow previously done through emails, spreadsheets, and some other less than efficient methods. Its addressable market is very large because of the sheer breadth and depth of the tasks that can be automated by using their software. So ServiceNow is basically just automation software, and you can customize that and use it to apply to anything. ServiceNow's offerings tend to save customers money and make their workflow less prone to error. The company's growth has been among the most consistent in our portfolio prior to and during and after the pandemic. That's one thing that's pretty incredible about this company. The pandemic came, the pandemic went, and ServiceNow just continued to grow all through it without any stop. If you bring up ServiceNow and you look at the revenue chart, it's a consistent growth. And they like having a few companies in their portfolio. They mentioned this, that they like having a few companies in their portfolio that have far above their benchmark 15% growth rate. So they try to grow around 15% per year, but they like companies growing 20% or above. The next one, which is one that's on my watch list, I'm trying to get back into Salesforce, but I just haven't got an opportunity. I consider a personal mistake. I think it was a mistake of mine to sell Salesforce for valuation concerns because it continued to just compound, raise margins, grow revenue, and now I'm in a situation of trying to jump back in. But Salesforce is the next one that they've continued to hold. They say that Salesforce has continued to grow its revenues at what we see as a healthy rate despite market concerns about the impact of a weaker macroeconomy on its business and penetration rates in its core CRM offering. Even its most mature and largest offerings, Sales Cloud and Service Cloud, are still growing revenue at double-digit rates. In addition, management realized that their cost structure, especially in salespeople, had gotten too bloated. That was one of my biggest complaints of this company. The huge amount of stock-based comp they pay, the huge, these equity packages that they give to salespeople are very expensive, and they had huge expenses with their sales and marketing. Over the past year and a half, the company has run on a much more streamlined expense structure that has led to strong operating margin expansion and earnings growth. I consider that to be an understatement. Salesforce improved their margins so much in a single quarter that it was about the same that I thought they'd do in a couple years. And they did that in a single quarter. So it's easy to underestimate how much a company can cut down on bloat and expense in a quarter or two. They can really just cut down on expenses quickly. They say importantly, we do not feel Salesforce has cut into its innovation or sales muscles through these cost cuts, but has eliminated unnecessary excess fat from the organization. I have a hard time referring to excessive amount of employees as excessive fat. I think it's a little bit demeaning to refer to people that way, but you get the point. Sometimes organizations grow a little bit more than they should. They outgrow their revenue and their cash flow, and you have to take that in a little bit. Now we get to Amazon. This is currently their largest holding, and they made a very similar prediction that I think was a very predictable one, that Amazon was going to grow an incredible amount of free cash flow and their margins are going to raise up. Now, when I look at Amazon, I've said that I think it's going to do around $70 billion of free cash flow this year. I think that the operating margins will be, I think, north of 10%. They're even more bullish. They're more bullish on Amazon than I am. That's saying a lot. I mean, these guys really predictably believe that Amazon will be a company that has north of 15% operating margins. So they say Amazon shares have appreciated 88% in 2023, driven primarily by rapidly expanding operating profit margins and free cash flow growth. After the pandemic, Amazon experienced a period of inefficiency and overinvestment in its distribution and logistics infrastructure. Now, again, all of this is accurate. I don't see anything that they're misrepresenting here. There's nothing that has caught my attention as them kind of twisting the truth or rewriting history. All of this is 100% accurate. Amazon overinvested in infrastructure, and that was a bit of a calculated move. They could have either overinvested or potentially underinvested and made customers unhappy. And of course, it's Amazon. They overinvest. They made sure customers were happy and they got their fast shipping. So they rather overshoot it and grow into their infrastructure than undershoot it and have to continue building infrastructure. Now, that was expensive, and that's why the stock fell. Amazon is now leveraging these investments as growth returned to its e-commerce business in 2023 after a highly unusual 2022. At the same time, Amazon's rapidly growing and high-margin advertising business is contributing strongly to the entire company's operating profit growth. The AWS, Amazon's web service, cloud infrastructure, and service business continued to slow in 2023 as customers anticipating a more difficult economic environment look to save money on their cloud spend. But these cloud spending organizations begin to stabilize in the second half of 2023. I run a business, Qualtrim is hosted on AWS, and I know that you can try to cut down costs here and there, but over time, as businesses grow, your cloud spend is going to grow. So the slowdown in AWS is a temporary phenomenon, and we've seen that the second half, it is stabilizing. In fact, the growth rate's actually increasing. Now, they really emphasize this next part where they say, and this is in triple-sized font, blue font, so they're really emphasizing this. Amazon remains our largest position as we expect continued double-digit revenue growth and robust and steady progress on the free cash flow margins from here. So even though they note themselves that Amazon has gone up 88% in 2023, even though the stock has rushed up, they still want it emphasized in huge font that Amazon remains their largest position. And in terms of position sizing, we look at this and Amazon is a 13% position, which is roughly 3 times the size of their average position, 3 to 4 times the size. So they're confident in saying, we're really leaning into Amazon. Even with its outperformance over the past year by a dramatic amount, we still see a very good future for this company. I like what I see here. I like their commentary on their companies. I like their logic behind it. I like their investment thesis. I just really find everything I read here is really interesting, informative commentary. We can move on to Airbnb. Airbnb is not a company that I own, but this is one they have. They say it continues to deliver double-digit growth in revenue and nights booked, which is especially impressive given the year-ago growth rates it delivered on these same metrics, 29% and 31% respectively. Despite these attractive results, the stock sold off as investors reacted to fourth quarter guidance that came in slightly below expectations. Coming into the fourth quarter, the stock was up around 60% on the back of strong fundamentals. Stepping back, nothing has changed. Private rentals continue to take market share from hotels globally, and Airbnb continues to take market share within the private rentals given its relentless focus on improving the guest and host experience. Looking ahead, we expect many years of robust earnings and cash flow growth from here. I really like Airbnb because it's an asset-light company that has huge network effects. So they don't have to own any heavy CapEx investments. It's just a software company, but they have growing margins that are growing like crazy. The only issue I have with Airbnb, the only thing that causes me concerns, is a lot of cities and local governments seem to hate them. They seem to want to ban them. They view them like a pest. It's like a different type of real estate owner, like a landlord that most cities really don't like. So that's the only thing that causes me a little bit of concern with Airbnb. But the results speak for themselves. This company has been a really good investment. Microsoft. This is one of my top holdings. Microsoft's business continues to grow well, albeit at a slower rate than in the previous few years. That said, it was a relative detractor to the portfolio because of our 7% average weighting for both the quarter and the year were significantly lower than the 12% benchmark weighting in the Russell 1000 growth. Microsoft shares appreciated a benchmark beating 19% in Q4 and 58% in 2023. They're basically saying, even though they own some Microsoft, it wasn't enough. So the benchmark owned more, and the benchmark beat them because it owned more Microsoft. In my portfolio, I am overweight Microsoft. I own a much larger stake of Microsoft than either the QQQ or the S&P 500. So I've weighted this one as a much bigger holding than the benchmark. Just like with Amazon's AWS business, we expect to see a reacceleration in Microsoft's business from generative AI. In addition, we also expect generative AI to help not just Microsoft Azure cloud service business grow, but also to be an additional growth driver for the company's productivity suite, Word, Excel, PowerPoint, and Power Platform, which helps build internal apps for businesses. So a lot of the thesis that you have for Amazon with AWS reaccelerating, all of this AI stuff, it's transferable to Microsoft because they're the second biggest cloud. And I view it the same way. Part of the reason I own AWS, I own Amazon, I own Microsoft, I own Google, is they're the three biggest public clouds. Microsoft has created generative AI Copilot, which are bots that use large language models to make customers' Microsoft software even more functional. As an example, Copilot offering for Microsoft can take text and data from Word and Excel and automatically create a PowerPoint presentation from it. We expect to see generative AI demand from Azure customers becoming a larger contributor to growth of that segment, while Microsoft Copilot becomes a premium feature of the high-end Microsoft commercial business, leading to better pricing. Given the strength of the company's existing business and the expected strong product cycle given the generative AI advancements, we chose to add to our Microsoft position, and now it's our second largest position behind Amazon. So they're giving their rationale and justification for adding more to Microsoft, making it a large second position holding in their portfolio. And when I look over this reasoning, I think it's very compelling reasoning. I think it's just strong reasoning. This is part of the reason that even though Microsoft is a massive position in my portfolio, I haven't sold any. I haven't sold any in the story fund. I haven't sold any in the passive income portfolio. Combined, it's a very large position. And I just see no weaknesses with Microsoft in sight. I see a lot of potential growth with what they're saying, integrating AI products into all of their commercial products. Now, they go on with Apple and Nvidia alone, drove over 1,100 basis points of the Russell 1000 Growth Index's 42% return. So not owning them was a meaningful headwind to our relative return in 2023. Now, I owned Apple in 2023. It was a huge outperformer. Since then, I've taken a little bit off with Apple. I've reduced my share because I just don't see as many growth drivers for it. But overall, this is true. If you didn't own Apple in 2023, you had a hard time beating the index. They mention some of the issues with Apple right here. They say while we continue to think Apple is a wonderful business, it is also a slow-growing one with risks that we do not see as insignificant. Apple's entire supply chain is based in China, and much of its incremental revenue growth has also come from China. So if there is a US-China issue that makes it more difficult for US-based companies that have access to large amounts of local data to operate in China, Apple's business would likely face more challenges than many others. The TikTok ban. That is immediately what comes to mind when I read this. And again, I found out about this firm in this write-up yesterday. So this wasn't something that I've had access to, but I agree with many of the reasonings here. I think if we ban TikTok, I could completely understand China retaliating with Apple. That's where they could cause the most pain. They could inflict the most pain on US business is with Apple. In addition, much of Apple's services growth and margin expansion has come from direct payments from Google to be defaulted search provider for iOS devices. This practice is currently subject to lawsuits between Google and the US Justice Department. If the practice is deemed unlawful, it could take away a larger and highly profitable revenue stream from Apple's already slow-growing engine. While we closely cover Apple, we continue to believe we have a better investment opportunities. So that's another thing that I cited as a potential concern. Now, Apple could replace some of that lost cash flow. They could build their own search engine or they could broker to try to get a deal with Microsoft. But either way, that would be an immediate blow to Apple, a large amount of cash flow off the table. Apple's current PE is above our portfolio's weighted average, yet its long-term earnings growth rate is likely to be lower than our slowest growing holding according to our own research. So they're saying the same arguments. Apple's already a big company, the PE ratio is not very low, and the company's growing a little bit slower than most of their companies. So again, I understand, I completely agree with this. I bought into Apple a long time ago when it was trading at like a 17 or 18 PE ratio. I bought a little bit more at a 22, and it's grown a lot, but I see a lot more challenges to its future growth. Now they comment on Nvidia. Nvidia shares rocketed higher by well over 200% in 2023. Although they slightly underperformed our portfolio and the Russell 1000 in the fourth quarter, generative AI has been a huge boon for Nvidia as the use of LLMs, ChatGPT, and others require tremendous processing power for that. Today is mostly powered by Nvidia's GPUs. All of the large cloud service providers, AI factories, and many large consumer internet companies are laying the foundation for generative AI by deploying NVIDIA's GPUs and other parallel processing chips to be able to do large-scale generative AI either for internal use, like Meta, or as a service to others, like AI factories, or both, cloud service providers such as Amazon and Microsoft and Google. This next paragraph I think is very interesting for their take on NVIDIA. It mirrors a lot of my opinions as well. Given many of NVIDIA's customers or its end customers are still very much in the experimentation phase with generative AI, it is unclear how sustainable its current demand is for GPUs. At the same time, it is known that NVIDIA has historically been a highly cyclical company. By the end of 2024, we believe that NVIDIA will already account for roughly half of the market for data center, chips, servers, networking equipment, which is completely unprecedented. Even though the valuation at 25 times forward earnings doesn't look very demanding at first glance, it assumes that NVIDIA will own virtually the entire data center chip market in just the next few years and will sustain year-on-year growth despite being a cyclical business that has currently experienced much higher new peaks. So they're saying this is historically a cyclical business. NVIDIA has basically owned half the data chip market, and it's priced as though it's going to take over the entire data center market, like the whole thing. They're just going to outright own it all. They continue on with their analysis on NVIDIA. We believe the market has already priced in a near perfect scenario for a cyclical business that has very little recurring revenue and is selling into a nascent market of unknown growth over the next 3 to 5 years. That is a pretty damning paragraph for NVIDIA. The market has priced in a perfect scenario for a cyclical business with very little recurring revenue, and it's selling into a nascent market with unknown growth. Basically, every risk factor you can think of, they're attributing to NVIDIA. We believe NVIDIA is a highly advantaged business, but we also believe the long-term growth outcome are currently too variable. And the expectations built into the company's 1.2 trillion market cap, it's much bigger now. It's gone up another 70% after they wrote this. So it's basically doubled in valuation since they wrote this. It's now above 2 trillion, above Amazon. It's a bigger company than Amazon. The valuation as of writing assumes the most optimistic of these scenarios. So Nvidia is trading with immense amount of momentum, and they're not buying it. They think it's too risky, too unpredictable. As a side note, we have a large holding in the 3 largest cloud service providers that are buying billions of dollars worth of GPUs and deploying their own custom AI chips, which will then be resold or rented as a service to large and small companies around the world. Our research shows that their capital expenditures on GPUs will turn into high margin recurring revenue streams. This seems like a more predictable generative AI growth model to us. To me as well. I own Microsoft, I own AWS, I own Google Cloud Pro. So these companies are going to benefit from AI, but in a very predictable manner. We believe these GPUs can easily be redeployed for other cloud platforms and infrastructure services. So there you have it. That's their commentary for 2023. And I thought it was overall very, very interesting. They're really big into Amazon. They really like Netflix. They like ServiceNow. They like Salesforce. They like Airbnb. And they love Microsoft. They don't like Apple quite as much. They don't buy into Nvidia at all. They think that one's super risky and unpredictable. And as you see with their returns, they're not going for the highest return. They're not going for double and triple the market. They're just going for steady state, consistently beating the S&P 500. So I thought I would just highlight this. I thought it was an interesting, informative update. Let me know what you think. That's all for this time.